Today we want to talk about risk. And the big question is, are you taking enough risk? Paul?
Well, it's a question as investors we should ask, particularly when it comes to our superannuation, because we know there's a strong correlation between risk and return. Essentially, if you take on more risk, then over time, that should translate to a higher return. And if you take on less risk, you get a lower return. So less risky investments, things like term deposits, traditionally will deliver a lower return because investors pay a premium for that return certainty. The government guarantee, that's why you're getting 1% return or even less.
Yeah, and in the short term, a risky investment can be very scary. And we also have to evaluate the potential for this risky investment to actually disappear and you lose all your money or in total.
Yeah, so let's actually look at the data just to actually prove that. So we make those statements, but let me just show you the data. So this looks at the median super fund performance to 30th of June 2020 over 1 year, 3 years, 5 years, 10 years and 15-year time periods. And we've categorised the funds according to their risk categories. So we have what are so-called all growth funds. They're invested just in growth style assets such as shares and property, somewhere between 96 and 100%. At the bottom of the table, we've got so-called conservative funds. They only have 21 to 40% invested in growth assets, things like shares and property. Most of their investments are in secure bonds and income-bearing assets. And as you go across the page, you can see that the categories of the higher growth assets have stronger returns. So let's go to the right-hand side, 15 years. All growth has returned 6.8% per annum, high growth 6.6%, growth 6.4% per annum, balanced 5.6% and conservative 5%. So over the periods 3 years, 5 years, 10 years and 15 years, Peter, the riskier the style of the fund, the stronger the performance.
And I should emphasise that inside a super fund, we are talking about quality assets as opposed to high risk assets.
Yeah.
So there could be quality high risk as opposed to high risk really crappy assets.
Yeah, these are just very diversified funds investing over very high quality assets, but we know that shares go up and down. We know the price of property goes up and down. That can happen within a year. Look what happened in the last year to the year to 30th of June 2020. The all growth, high growth and growth funds, they delivered on average, on the median fund, a negative return.
Yeah.
And the balanced and the conservative funds delivered a positive return. This is what the issue we have to deal with our fund performance. The chances of getting a negative year or a negative return are actually a lot higher if we take on a riskier style of investment. So let's go to the next chart, Peter, that shows the financial year returns of growth funds, the median growth fund financial year return from the period 1993 to 2020.
And is this capital gain and income,
Yep,
Paul?
that's the total return. And we can see that that's a 28-year period. And we can see, for example, that in the first year of 1993, the average or the median growth fund return was 11.3% and then 7.1% in 1994. But you'll also note in the red, there are 4 years of negative returns, 2002, 2008, 2009, and 2020. So 4 out of 28 years, that means, sort of a 1 in 7 chance, maybe a little bit higher, of getting a negative return from your super fund for the financial year.
So the good years are plentiful, but the bad years say something about the importance of timing too.
They do, and look at 2008 and 2009. If you're taking your money out of your super fund there, you did pretty badly. That's what we actually call sequencing risk, Peter. So let's talk about that. That's the risk of taking your money out at the wrong time. Now, that doesn't mean you go out there and want to take the money out, but if you're drawing a pension out of your super fund and you need that to live on and the market is going down, that can be pretty costly. And that's one of the issues about taking on too much risk, is if you get the timing right, often forced upon you, then you can actually find it really tough. And that's exactly what happened to people that sort of retired sort of 2007, and had to take their money out in 2008, 2009 at the height of the GFC.
But also brought the panickers who were in growth to the top of the market to November 2007, and then they saw the market fall and they pulled their money out and went to cash. They lost double, didn't they?
They lost double, and it took a long, long time to get back in the even. So in the black. So that's what we talk sequencing risk. That's the risk of taking the money out at the wrong time. And what it basically says is withdrawals in a bear market are far more costly than the same withdrawal in a bull market.
Exactly. Well, how much risk should we take?
There's no right or wrong answer to that question, Peter, but let's just look at a couple of truisms. Typically, those who are younger and who don't need to access their funds, in other words, they need to take money out again of their funds for many years, should take on more risk.
Yeah.
Those who are older and those who may need to access their funds in the short to medium term typically would say to take on less risk.
Yeah. So they might go from growth to balance. Or
because
balance
of that
and
whole
service.
issue of sequencing risk, right? But there's no right or wrong answer, and you've got to do what's right for you and also what you're comfortable with. So if you're going to take on more risk, there's going to be the odd sleepless night because chances are your super fund or your investment portfolio is going to have a negative return, or you might have some investments that you're going to lose money on. If you don't like that, don't take it on.
Yeah.
So it's got to be sort of what's right or wrong for you, and that's what we'd say is the most important thing.
Yeah, and I think the important point, Paul, is that if you look at these stock market cycles, they often go around 10 years. The first 2 years can be a bit dodgy. You can probably get some growth orientation during the third, fourth and fifth years, and then go conservative towards the end if that's what you're worried about. But that's still a gamble, isn't it?
It is, and that's something we'd often suggest to people they need to change their profile. Finally, Peter, I think just to re-emphasise why investment returns matter so much. So what we've got here is just to show the difference between the conservative fund over 15 years and the median growth fund over 15 years. Didn't sound like a lot of difference, 5% versus 6.4%. But I just want to show you what that actually translates to in numbers. So if you had $100,000 invested in a conservative fund at 5% per annum for 15 years, at the end of that period you have $207,000. If it was invested in the growth fund at 6.4%, you'd end up with almost $254,000. That's almost a $50,000 difference. So quite a lot of difference. And so investment returns do matter, but you have to sort of be comfortable with the risk that you're taking on. And just be conscious about when you're going to need that money becomes really important.
Yeah. I think the important point from the story, particularly for younger people, is don't get too conservative too early. You've got a lot of economic cycles and market cycles ahead of you before you retire. And a mate of mine did go conservative at a very young age, and I reckon he cost himself $200,000 to $300,000 in his super when he retired.